against the dollar, weaker than almost anything else. Here's the continuous contract. This also looks pretty good. I mean, if you take a look here at where you've got sort of immediate support, I'd say it's probably not something that I would. I mean, I am shorted, but it's probably not something I would sell again until we took out whatever this thing is here.
Mm-hmm.
But on the other side of it, there's not a whole lot but air. So
Mm-hmm.
down to here somewhere, down to here somewhere. I mean, there's all kinds of room down here. Then you've got the Aussie. There's the Aussie. Again, it sort of depends execution wise, kind of when you want to go. But Aussie is approaching some very interesting support, basically right around here. And so if you get a break there, then I would think down here somewhere is kind of an easy stretch. So if you can sell it right here somewhere, all the way down into sort of on approach to 64, that
Yeah.
looks nice. That's a setup. Um, and Thomas, you mentioned the yen. Here's the yen. The yen is kind of interesting because if you look at it on the futures side, it looks like it's essentially just raging higher. It's taken out this, or dollars raging higher. It's taken out whatever this support was. And we spoke yesterday about this idea that once the yen runs, it tends to run. So ostensibly, you've got still a bunch of room down here. And so I wouldn't overthink it. You could very easily get back down here. And so since you've taken out this support, basically, now, whatever this low was, and now you essentially have not very much that's in front of you. I mean, there's not a whole lot of sticking points now. I mean, maybe down here, then down here, but there's a lot of room. Uh, I'm short. I'm going to stay short. I'm doing it to keep things small. I'm doing it on the Tasty FX side. So I'm doing it over here. I'm not using futures or ETFs. I'm doing it right here. I'm also a little bit along dollars against the Singapore dollar, and I have a little bit of extra, a little bit of a kicker on my euro exposure. I'm very short the euro now. A little bit of a kicker on it through spot as well. But you could get a position here on yen via spot that's very small. I mean, you don't even have to go 10K. I mean, point 0.1 of a full contract would be 10K. You could go as small as 1K. You
Mm-hmm.
could get a real small dollar yen position out here if it feels stretched and get something on.
Yeah.
And then if it keeps running, it keeps running. You pick some up. If not, your exposure is tiny. And so if it backs off on you, then you take a little loss, you wait, you go again. The thing with yen is you can sit there and wait until the end of time, and it will never turn back. I remember when Shinzo Abe was first about to be prime minister, and it was clear that he was going to nominate somebody that's ultra dovish to the BOJ. The yen just started selling and didn't look back for like years at that point. And this new prime minister, Sanae Takaichi, she's Shinzo Abe's protege. That's her thing as well. She wants a dovish BOJ. So it might make sense to nibble on this while there's nibbling to be done, because it might just be a one-way ticket now.
I mean, the thing that seems the most detached from everything, and you already kind of mentioned this, Thomas, was the NASDAQ and the Mag 7. Like the supernova piece is the least, I think, is the least
Yes.
affected or the least relevant that all this discussion, whether it's the Middle East discussion or the currency discussion, that this thing exists in its own universe, basically. And that universe is one of varying degrees of optimism or extreme optimism, depending on the day, for some sort of unknown but widely believed fabulous, fantastical sort of future. But it does kind of bring up I know that there's been sort of these, I've seen these headlines and there's been the discussion on the electricity side that the limiting factor, or that one of the limiting factors on the supernova is ultimately going to come down to the cost of power generation and the ability to generate power and the efficiency of the use of electricity. And I know that that's been a sort of derivative of the supernova, the AI trade as it is, but I do wonder the degree to which those names also continue to attract a lot of momentum, not just the headliners that we all know.
And I mean, if you see oil, natural gas more than anything staying low, I don't think it'll be as much of a throttle as, say natty gas prices this winter run up to 5 or 6, pretty high, but not out of the realm of possibility. Then it'd be interesting to see how they react running these data centers that consume a huge amount of energy. I was actually talking to someone over the weekend that manages the facilities for a data center, and one of the new ones they built wasn't hooked up to the grid yet, so the utility didn't come out, but everything else was in place to go, including their generators. So they decided to run it up already using the generators until they get hooked up, which was another 2 or 3 weeks. That's 36,000 gallons of diesel fuel per day, which is, I think, somewhere around 300 to 500,000 a day, just to get that data center up and running. That's how antsy they were to get this data center online. So I mean, the constraint ultimately, not only on AI but all technology, is ultimately energy. So I mean, the thing is, the bubble, or people saying it's an AI bubble, isn't really true yet. It might be a bubble on spending towards AI, all these companies rushing to stay in the game. But as long as the spending is there, I think the speculation in the stocks stays there, and I don't see it popping or bursting anytime soon, really.
Yeah, I mean, there's an interesting article out in The Economist this week, basically talking about whether all of this AI optimism makes sense kind of in the build out ultimately because of things like this. Because, for example, data centers are being built and facilities are being built where it is cheapest to build them, and so they're far away from population centers. They're far away from people who would work there. So it's all kind of disaggregated and difficult. There's the energy cost piece. There's the deployment piece, which isn't happening at this point at the kind of scale that the building of capacity is occurring. And so their kind of larger conversation is there is, as is typical with these kinds of things, a mismatch initially between supply and demand, where first there is tons and tons of supply because enterprising suppliers kind of see the opportunity and judge that this supply is going to be needed. But demand is more difficult to convince, right? It's kind of like, well, how many iPhones did Apple build before it unrolled the first iPhone, the first sort of thing of its kind? And how much demand was there for that until they did it? Well, if people don't know and can't even fathom what the thing is, probably not as much demand as there was after it appeared, and like some use cases actually started to exist. And for a long time, there was a mismatch between supply and demand. Well, maybe we're looking at that, and maybe that's normal. I think to your point, Thomas, the question is, at what point does the market take a breather and go, well, okay, we've got tons of AI supply. Are we going to have enough demand to justify all of this supply? And there's no knowing when. I mean, this is always a thing that happens, but in these types of things, I mean, railroads, telecoms, whatever, there's always that phase or that kind of interregnum in the story, but who knows when it's going to happen. But there's certainly no sign of it here.
I do still come back to my Amazon thesis in the sort of internal rotation of the Mag 7, and I think Amazon is a great buying opportunity. I mean, that's a ridiculous statement, but I think that Amazon, on a relative basis to the AI names, is attractive. How about that?
I mean, there's certainly a lot to be said for this. I mean, obviously,
I mean, look at
first
that
of all,
AMD move the last few days. We've seen all these. We've seen so many different moves. I won't list them all. But
yeah, I mean, what's interesting about Amazon,
in the
probably
queue
to your
for a
point,
move
is that
like
it's not AMD.
What's that?
What's probably the most interesting to your point about Amazon is that it's not AMD, in the sense that AMD has already had a giant pop, and
Yeah,
this
but
thing has
AMD's
not.
had a pop, Google's had a pop, Tesla's had a pop. I mean,
Right.
I'm saying the point of Amazon is that it is in this. It's a cousin of the family or a sibling,
And
of the
hasn't had a
family,
pop yet.
and hasn't had a pop.
Right. Right.
And so I just think all the Mag 7 names, the Amazon, even if it's a put spread or what the mechanism is, but if you're gonna, that's the most interesting thing to me right now.
Well, so interestingly, if you wanted to get very kind of simple here and say, okay, here's 50 days out. Obviously, this is in somewhat fuzzy pricing because we're after hours here. But if I wanted to just be a put seller here and look at it this way, and essentially say, okay, where's the next pocket of liquidity here? Let's say around maybe there, something like this, maybe here. You could structure fairly sort of solid risk reward ideas here on the put selling side. Now, it is a little bit expensive, but you could tinker with this a bit. See if we can, there we go. 43 days out, better volumes. You could structure something pretty, I mean, even very small here. I mean, when you're selling premium approaching 1-to-1 risk reward with a 54% probability of profit, I mean, that's pretty good. That's pretty good.
Very good, right?
Right. So you could do this and basically sit on this for 43 days and just bet on vol extraction and just take the vol credit. So it's an interesting setup. Thomas, can I get you into an Amazon position here?
Yeah, I think that's a pretty good move. I
Would you be
like it.
doing?
The only equity I've really been doing is Tesla, and I've been selling put spreads on it.
I mean, this thing
Well,
here,
on the
obviously.
same premise, I mean, if that would be the same rationale,
Yeah.
Thomas,
Yeah.
for the,
Yeah.
for the Amazon put spread.
I mean, hypothetically, say, because this is kind of an arms race in AI between the US and China. Say that unlikely, but the US companies stop spending while China is investing more and more with lofty targets that are probably unachievable with a lot of things they do, but nonetheless, they drive the regional governments to promote infrastructure spending on that and stuff. I don't think the U.S. government would just watch the U.S. really significantly slow spending in AI if China is continuing to spend. And I think that's when you see, the U.S. right now, the government is taking more and more positions in companies privately. Do they start to do that more and more with chip companies, which I think they're already looking at? But the spending on AI, it already goes far beyond spending in other arms races like the space race, the 50s and 60s between U.S. and the Soviet Union, which also benefited stocks in the economy, minus the drag when the Vietnam War started.
Yeah, I mean, there is certainly an interesting element here. I mean, obviously, we know that all that spending during the Cold War eventually gives us the internet, eventually gives us telecoms, and telecoms follow this kind of arc where once telecoms arrive at the sort of internet breakthrough, there's the run up, and then there's the sort of oversupply, under demand moment in the .com bust. There's a reset, and we come back. What's interesting about all of that is there seems to be a conversation emerging that basically what was happening with the .com thing was different enough from what this is, where that was about valuations. And I mean, I don't know if I buy this argument, but I read it earlier today, that bubble was about valuations. This bubble is about sort of the use case, that we don't have adoption, and that this creates the disconnect. That essentially this is less like railroads and less like telecoms, and maybe more like the South Sea bubble, where everybody's like, oh my God, we need to go invest in North America. They're doing all the new stuff there. But it becomes something that for a long, 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 long time doesn't get off the ground, and the investment ends up basically burning out because, I mean, there's a revolutionary war and it destroys a bunch of, it wipes out a bunch of investors, and there's a very slow start, and the colonies don't get along, and it's not exactly just a printing money outpost for England the way, let's say, India was. So it's a different kind of thing, is what one argument here goes to say, and that it's also a credit bubble to some extent, because since all of this is financed with borrowed money, that if you can't get ROI and you can't get demand quickly, the thing caves in, at least sort of episodically before the long arc kicks off. But all of that is complete kind of yada, yada, yada until the market decides to care, and the market doesn't care.
So is this consolidation in mags? I mean, I see it just as a consolidation before the next step higher.
I don't think there's any evidence to suggest that it's anything other than that at this point.
All of which goes to, pick Amazon as the laggard in the bunch, because it's all going to go one way or the other. It's going to go up and down, but it's ultimately going to go up. And Amazon, I just feel like is the one that I'm a broken record right now, but I just think Amazon is a really, really interesting situation.
It's an interesting piece before we jump off here, just to get your quick thoughts. So a piece that came out of the Boston Fed today that said the recent spike in inflation expectations poses a bigger risk to the U.S. central bank's ability to tame inflation than historically, and basically points at the 1970s and says that this here now is more like that, in the sense that inflation expectations are becoming unhinged, and that we have a kind of thing here where there was an inflation cycle. The Fed responded with rapid hikes, but inflation expectations ultimately became anchored anyway, and it took multiples of these hikes. If we recall, Volcker had to do it twice. So big hike cycle, crushed the economy, cut rates, inflation ran away again, had to do it again. That this is sort of like that. And that ultimately what we're going to end up with is much higher rates. I bring it up because, of course, the study comes from a study of one-year inflation expectations in the University of Michigan survey, which comes out tomorrow. Do we think this matters in this context? If we get higher consumer inflation expectations for lack of other data tomorrow, is that something that can give this market indigestion in any kind of a lasting way?
I don't think so.
Yeah, I don't think so either. Maybe
I don't
for
know.
like an hour.
Yeah.
And then you forget about the U of Michigan data and keep doing what it's been doing.
I think that's the path of least resistance. And if it's not that, then it's interesting. If the U of M data actually gives a strong reaction from the stock market, I'm looking at the data closely, not because I think it's going to, but because I think it would be fascinating and a game changer if it did. Because it would suggest that something different is finally starting to occur. And maybe, just maybe, it's time to think. Thank you, gentlemen. Overtime is herewith out of time. Don't go anywhere, anybody. Macro Money is going to be on right after this, where, surprise, surprise, we're going to talk about the University of Michigan data and why it might matter. But if all of this today starts with the dollar, that data could move it. And maybe something finally is stirring that's different than the autopilot we've been on. So don't go anywhere. We're going to come back momentarily and have that conversation.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
New from tastytrade. Unlock 30 days commission-free trading, plus a 1% cash match on all qualifying deposits when you open and fund a new tastytrade account. The Money Match event starts now, exclusive to new tastytrade customers.
Frequent trips to Vegas, or there was a year I did a couple of them.
What's the most financially irresponsible thing you've ever done in your life? Doesn't necessarily have to be trading specific.
Financially irresponsible, that's a big question. Like people would say like going to college these days, I don't know. Renting, I like renting. I like the flexibility. I don't know. Maybe renting, I guess, by the book is financially irresponsible. Actually, you know what my biggest purchase right when I started my job was $4,000 on a PC setup, which was not a good idea at my salary point.
I mean, anytime you take a trip to Vegas, it's pretty financially irresponsible. I would say that frequent trips to Vegas, or there was a year I did a couple of them, which was pretty irresponsible.
When the market moves, traders need to move faster. tastytrade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, tastytrade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on tastytrade.
When you define risk, you set a limit on how much you could lose if the trade goes bad. If you have a small account, you might not be so interested in selling naked options. You'd use up much more buying power, and the risk is undefined. Defining risk, though, controls how much you can lose if the trade goes sour, and it gives you back some of that sweet, sweet buying power. We can define risk by combining options into certain strategies. The short put vertical spread is the simplest one. Selling this put sets your max profit with the credit, and the long put at the lower strike blocks off the risk where you want it. And if you're more neutral than this, you can throw on a vertical call spread to make it an iron condor. The only downside to defining a risk is that it lowers both your max profit and your probability of profit. That little compromise might mean you rest easier though, and a good night's sleep is priceless. So see, we can define risk when we use more than one option at a time. Pretty simple.
It's the day that when you write dates in the American system of month, day, year, which is a little bit funny, looks like 3.14, which is one of our better approximations. And actually, this year is even better because it's 3.1415. I've never before, but this year there's a couple other math people who just got a pizza oven, and so they're bringing everyone over. We're gonna make a bunch of pizzas. It's one of the few very important transcendental numbers, right? I mean, 0, 1. There's a lot of good contenders for most important number. Anytime you have anything that's circular, you're going to wind up with pies. Anytime you have a pie, you should sort of expect there to be something circular. I can do one more than the date on Saturday. I can do 3.14159. Irrational numbers are fractions, and pi just is not a fraction. 22/7 is pretty close, but that's not what it is. It's the ratio of a circle to its area, right? And so that's not an integer ratio. It just isn't. Oh. Pumpkin. Just circles are great.
All right, Katie, what is the Widowmaker?
The Widowmaker can be any spread that is volatile that might dink you if you're on the wrong side of it, but at tastylive, the Widowmaker historically has referred to a spread in natural gas.
Refers to profits that you are taking on a position.
What is an offer? So the offer price is the price at which you can buy an option at, the bid being the price to sell at.
What a weird day we had in the markets today. All kinds of big moves, but not a whole lot of obvious catalysts for why we saw what we saw, and therefrom, not a whole lot of clarity, perhaps, on where things are going. Or is there? We have the first piece of major economic data on the calendar coming up in the next 24 hours. And maybe, just maybe, the markets are finally ready to do something different than what they have been. We're going to try to figure out what that is. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we'll start with is just a look at the price action, just to figure out what in the world happened today and why it seemed to be so. And from there, attempt to figure out what's coming next as we take a look. I mean, obviously, through this government shutdown, we've had a lull in most economic data, but the private sector sources, they do keep coming. And for the first time this week, we're going to get a piece of data here of some consequence by way of the University of Michigan consumer confidence data. So we'll take a look at that and see what it might mean. Here's what the markets did today. Soggy one for stocks. S&P 500 off almost 0.4%. NASDAQ down about 0.25%. Both of them were down meaningfully more intraday, but ended up clawing back some losses. At one point here today, the S&P was down as much as 0.6%. At one point today, the NASDAQ was down as much as 0.75%. So these were bigger moves, and they've since unraveled somewhat, but nevertheless, the exuberant surge to record highs yesterday did not find follow-through today, and we kind of came back limping. Yields up narrowly, so that idea that yields and stocks are moving inversely of each other, that's on display here. The 10-year up 0.4%, the 2-year about the same. The dollar stronger across the board. Euro down 0.5%, yen down about 0.25%. Bitcoin doing its amplified risk on thing. So stocks are down, Bitcoin's down more. The interesting bit here, perhaps, in the commodities space, where gold is down hard, almost 2%, and so is crude oil. And so as we look at the sort of makeup of what's going on here, it starts to get interesting to consider kind of how you build a through line on all of this. And when we look at the price action intraday, we can see here's the S&P 500. The sell-off starts right at the cash equity open. I mean, this is it right here. These timestamps, by the way, they are in Pacific time because, of course, this is my platform and I am here in San Francisco. So what you see there is a screenshot of what was going on at about 9:30 Eastern. And so this is right at the cash equity open for Wall Street. And we can see right out the gate, we get a sell-off in the S&P 500, and that ends up looking like a sell-off across essentially all of the U.S. stock market universe. Obviously, some things came back more than others. NASDAQ fared much better ultimately than the S&P because most of the selling was in energy, industrials, and in materials, and tech was actually fairly okay. But nevertheless, we have a sell-off that starts right as the markets come online. Gold sells off at the same time. Again, right as the markets come online, gold takes a hit and is down then for most of the day. The dollar has the same cue here for its rally. There it is. And so as we look at all of this, it starts to sort of raise a question of, okay, well, how do you make sense of what's going on? Well, if you're in a situation where, let's say, this is certainly the headlines that we've seen across the wires today. Oh, well, we have a preliminary ceasefire deal in the Middle East. Israel and Hamas have signed up to the initial stage of President Trump's framework, his 20-step continuum on securing lasting peace. They've signed up at least to the first part. And it would make sense, perhaps, that crude oil would be down in this context. It would make sense that gold would be down in this context because ostensibly some degree of geopolitical risk has been baked out of these assets. But if that's what's going on, and if these moves started at the same time as all the others, including stocks, including the dollar, then how does it make sense that peace breaking out in the Middle East is a bad thing for stock markets? It doesn't seem to make a whole lot of sense. Not only because stock markets haven't really cared about wars, not the Ukraine-Russia theater, not the Israel-Hamas theater recently. Of course, we did hit record highs yesterday, and these wars continue. And then we hit record highs over the course of the past at least year continuously, and the prior year too. So, and all these wars have continued. So it's not as if this has been a major headwind, geopolitics, for U.S. stocks. And in any case, it would be strange that an improvement in the situation would be negative for risk taking. So it's probably not that. It's tempting to say that what might be going on here is something having to do with yields. We've seen that the market has been very sensitive to this idea that the Fed might not do as many rate cuts as expected, and that this will mean less cheap money for the markets, and at a time when you're at record highs and people are starting to worry about, okay, well, maybe this is overextended, maybe I need to buy some protection, maybe there's a downturn that's inevitable, and maybe inevitable, quote unquote, is getting closer. So we want the money to be cheap in the event that there's a wipeout, because then we can borrow back without too much pain and go again. So perhaps this is about yields, but that doesn't seem to square with what's going on elsewhere. And we can see here the bonds, they do have a little bit of a run-up here, but here's that same window of time. At the time that all of this is occurring, there's nothing really that's happening in the bonds. They do have a slight downtick here today. That happens earlier in the day, and it really is very, very modest. So yields are a touch higher, bonds are a touch lower, but it doesn't really change the calculus in any kind of a meaningful way. In fact, we can see Fed policy expectations basically not doing anything. This is the outlook for October. We can see steady relative to yesterday. It's moderated a bit versus a week ago, but it's much, much higher than it was a month ago. And so still basically a given that we're going to get a 25 basis point rate cut later this month. It's not dissimilar for December. Back over an 80% chance of a cut there. It got a little weaker yesterday, but we're still slightly lower than when we looked a week ago, but much, much more convinced than we were a month ago. So still looking like we're firmly set for cuts at both meetings. And when we look at the overall policy outlook, the same general dynamics hold. most importantly, we can see that we've been basically oscillating here around about 100 basis points in easing between now and the end of next year. That hasn't changed now for the better part of 2 weeks. Moreover, we still have the disconnect for next year. 61 basis points is what the markets have, and 25 basis points is what Fed officials had written down in their summary of economic projections in September. So it's not like we've made any meaningful move here one way or another. So it might be tempting to say, well, what's going on here is yields, and so stocks didn't like it, and commodities didn't like it, and the dollar did. But we don't really seem to have any meaningful changes in the policy outlook. There is something more to this story, though, and perhaps it just doesn't begin with bonds. Perhaps bonds are sort of a bit higher on yields today. They were a bit lower on them yesterday. They're kind of oscillating, and have been for a few weeks here. But perhaps what this story begins with today is the US dollar, because that would start to make these things make sense. So if the catalyst is here, if the thing that ultimately kicks this off is a dollar rally, well then things denominated in dollars would go down. And that would, in parallel, strike at gold. It would, in parallel, strike at stocks. And perhaps that explains what we have on the board here. Because the dollar really is running roughshod today against everything. And maybe that's where this story starts. Now, within that context, we do have a bit of news that might illuminate what comes next. And as we were saying at the top of the show, we have what is the first piece of macro data for the week. This is coming at us from the University of Michigan, their long-running consumer confidence survey. It's been running for decades. And the expectation is that we are going to get a pullback basically across the board. Not a big change in the expectations index, but the assessment of current conditions, the overall sentiment index, those are expected to tick lower. Now, these gauges here have had a really interesting relationship with the one-year inflation outlook that's baked into this survey. One of the things that the University of Michigan asks is it asks consumers not only to give their assessment on the current conditions and expectations about 6 months forward, and from that the sentiment index comes, but also on 1 and 5 year inflation expectations. And this one-year outlook is really a very interesting barometer. We can see that as inflation expectations started to build in early 2021, you already saw, before the Fed owned it, that inflation expectations were starting to get sticky, that you weren't going to have, in the Fed's parlance, a transitory inflation episode, which, by the way, is exactly what they're talking about now. But before, it was trade disruptions from COVID and supply chains will realign and these things will ultimately be a one-off and they'll work themselves out. Now it's, well, the tariffs, they're a one-time adjustment. It's a one-time realignment of supply chains. Things will work themselves out. It's the same story. When these inflation expectations started to build, it became obvious that that story was wrong. And ultimately, the Fed had to own that it was wrong. And by June of 2021, they said, well, looks like inflation is going to be stickier than we thought. We're going to have to go on a rate hike cycle. We can see here then, at the beginning of 2022, when they go on the rate hike cycle, that's where inflation expectations peak. That's where sentiment bottoms. And once inflation starts to come off that's when sentiment turns a corner. Consumers start getting happier. Inflation falls all the way through going into early 2025, late 2024, until we roll out the tariffs. And you can see that with that rollout, inflation expectations surge, sentiment starts to come off again. And of course, this matters quite a bit. 68% of US GDP is household consumption. If consumers are not happy, there isn't any economic growth to speak of. So, what is it that we're seeing here? Well, on one hand, we see that the US economy has been putting up relatively solid economic data. This is the City Economic Surprise Index. We can see most outcomes here have been generally coming out better than expected. That's readings above 0 on this index. If data was underwhelming, then it would be below 0, but we can see all the way since July, things have been pointing to improvement. And then we look at the Atlanta Fed GDP Now model, and as we've said here before, what it actually says about third quarter GDP growth isn't very important. That number is ages away, and so this data is going to change, this model is going to change 1,000 times over before then. But what we can see is that the tone of the data that's been going into this model, because every time there's a major update, sometimes it's every day, sometimes it's every other day, it's been slower with this government shutdown and there being less data. But typically this is, hence GDP Now. This is a nowcast, as it were. It's updated in close to real time, and you can get the sense about whether the data going into it is making GDP look stronger or weaker. And here, the trend is unmistakable. So we appear to have some degree of U.S. economic strength here. If we look at the ISM data, obviously the headline indexes were especially soft. We basically had the U.S. economy register at standstill in September, according to the ISM data. But when we look at the price index subcomponent of that data, that's this right here, especially in the service sector, the biggest part of the overall economy, we can see that it tends to move and foreshadow what happens on headline inflation numbers, PCE and CPI, by about 2 months. And what that would imply here is that perhaps there is now an inflationary run that's shaping up on the horizon. All of which might give you a rise in inflation expectations here and help, first of all, to work out how you end up with weaker sentiment, but maybe start to feed into what the Fed has been saying about, well, consumer inflation expectations are the thing we're not going to allow to get sticky. Yes, we want to ease. It's because the labor market has shown up some more signs of weakness than we thought, but we are not going to backslide having done all this work to bring inflation down. That's, of course, this right here. I mean, clearly, heroic work has been done to take inflation from well north of 6% for PCE and well north of 8, approaching 9 for CPI, to bring all of that back down into the kind of 2 to 3% range. So the Fed is very keen not to give that progress back. Now, looking at the markets, they're not terribly concerned about inflation, it would seem. The bond market's readings of break-even rates, the bond implied inflation expectations, they're holding fairly steady. But if all of this positive data here portends to a more chipper economy and suggests that inflationary pressure is still getting a boost, and we still have that concern to worry about, we can't just abandon it and go straight to the labor market, that sort of is explained right here. We can see that the price index for ISM is still very, very elevated despite the actual headline economic activity index looking weak, especially in September. Well, then this is going to be a reason to start to worry about maybe Fed rate cuts aren't coming in the kind of volume that the markets want them. Maybe this is ultimately wrong and too big relative to this. The Fed only, again, forecasting 25 basis points, and the markets are at more than double that here. And perhaps that then gives us more of what we're seeing here. Higher yields, a stronger dollar, and then perhaps knock on across all of these dollar-denominated assets, including stocks and including commodities and including Bitcoin. And perhaps this might give us that vector for follow-through. So positioning-wise, I am still, as I've been for a while now, very long the US dollar, short the Aussie, short the pound, short the euro, short the Canadian dollar. I'm also short the yen in my TastyFX spot account. Short a little bit of stocks, looking for whatever this consolidation is to maybe finally resolve a little bit on the downside. Long the bonds, where we're still consolidating. Short crude oil, which is starting to work finally, but maybe is just getting going. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I usually co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back next week. Happy trading.